Joseph Zock, one stock you like over at Tocqueville Asset Management is SolarCity. It's down around 8% so far this year, but there's a lot of worries about the solar sector because oil is dropping. What do you think?
Correct. Well, that does make sense, and the consensus does have an argument. However, SolarCity provides financing for installation of solar panels. So they don't make the panels. What they do is they help you lower your energy costs. And their primary clients are in California and Arizona, where solar energy is much more consumed than it is here in the Northeast. But importantly, a solar panel would cost you about $20,000 if you just went out and bought it off the rack and tried to install it yourself. So they can get you into that same panel for zero money down, and it will reduce your energy costs going forward. So the common thought is that as energy goes down, oil goes down, which is happening. I know today there was a big drop, and SolarCity went down today as well, that would impact it as if it was a one-to-one relationship. But it really is uncorrelated, and it will take the market a while for people to realize that.
All right, well, you're also bullish on McDonald's. They're having a pretty good year. The stock's up 8% despite the fact that the franchisees are rebelling against the company. They're trying all new things to fix the brand, including breakfast all day. So tell me why you like it.
So they've had a decades-long problem with PR, starting with the movie Super Size Me, the Pelham versus McDonald's, or Pellman versus McDonald's case, where two young women sued McDonald's for their nutritional flaws. And every so often you would see a negative about what they're producing. That has changed, and in the interim, Five Guys, Shake Shack, Americans haven't stopped consuming hamburgers, and so they have an opportunity to change the menu. As you mentioned, the $1 menu and the breakfast menu are the most recent. They're changing their advertising. They're changing the focus of the company. They have a tremendous foothold in real estate, and they're an underleveraged company, so there's lots of room to do something with the balance sheet. So we think that as they emerge from this decades-long PR problem, that the stock could be really something that should be in many portfolios. It also has a 3.5% yield, so that's attractive.
All right, and you're also positive on Signature Bank. This is a New York-based lender. Stock's up around 12% this year. How do they compete in the land of money center banks? What stands them apart? Basically,
they're more nimble. They have a very lean management style. Most of their loans are made to people who are borrowing less than $30 million. They have a huge component, or a significant component, that's medallion-based, taxis. So that has driven the stock down. And we are a contrarian value manager. So we want names that have some problems, at least visually, that we can take advantage of the price being down. So that's what's taking place. So they're more nimble, they have a better loan portfolio, and they don't have the restrictions that many large banks do, governmental regulatory restrictions that are plaguing the industry right now. So many banks are hamstrung.
Well, Kansas City Southern is certainly a contrarian play, and it's a stock you like. It's down around 20% year to date. What turns this railroad around?
Right. So it has greater profitability than the other major railroads. Its major line goes into northern Mexico, which is a productive part of that country. They're importing goods or exporting goods to the United States. You know that there are containerized ships that offload very close by. So it's a very vibrant route, and the regulatory agencies have been very favorably disposed to that route. They're also small enough that you could see that there could be some M&A activity that would take place if a larger company wanted to secure that route.
All right, well, thanks a lot, Joseph.
Thanks.
And thank you for watching The Street.